The Australian Financial Review.
After more than 3 decades of enjoying guaranteed inflows from workers and very little scrutiny, Australia's big super funds are no longer flying under the radar. Rising customer complaints, a high-profile court case, and reviews into the way the industry funds choose their board directors and spend their money has put the spotlight on the sector. Politicians, regulators and experts are concerned that the $4 trillion industry's operations and governance have not kept pace with its meteoric growth.
Grieving families and people with disabilities have been left waiting for $20 million of their insurance money by one of the country's biggest super funds.
Last month, the corporate regulator launched legal action against one of the biggest industry funds, Cbus, alleging it was too slow to process millions of dollars of death and disability payouts.
If they can't pay insurance claims and death claims when they should, then what they're doing is failing to do the main job that they've been appointed to, help people manage and enjoy a prosperous retirement. So I think that's where you start to get the risk of confidence in the sector starting to crack.
Welcome to The Fin. I'm Lisa Murray. Today, Chanticleer columnist James Thompson and reporter Hannah Wooten on why ASIC is suing Cbus, what it means for industry funds, and whether super wars are back. It's Thursday, December 5. Hi, Hannah. Hi, James. Thanks for coming on the podcast.
Thanks for having us.
Thanks, Lisa. Nice to be here.
Hannah, earlier this month, the corporate regulator launched a landmark case against Cbus that triggered a broader debate about the management and governance of the enormous industry super sector. Give us a rundown on Cbus. How much money does it manage? Who are its members? And then tell us about the case.
Yeah, so Cbus is one of the bigger industry super funds. It was one of the first founded back 40 years ago when super first got up and running. It's got about $94 billion in funds under management and about 920,000 members. That is predominantly construction and building workers, but they've merged with a lot of super funds since. So, for example, they merged with Media Super. A lot of my colleagues are with Cbus. It's more of a mix now, but it has stuck to that initial blue-collar work base pretty strongly. So last month, the Australian Securities and Investment Commission sued Cbus for at least $20 million it said it owed bereaved members or disabled members.
My name is Christian Fock. I'm the CEO of Cbus Super.
They said that Cbus had been failing to process these complaints in a timely way.
Firstly, I do want to again say sorry for the impact that the delays in processing of insurance claims have had on our members and their families.
A lot of people have their disability insurance through their super funds, or there's these things called death benefit claims, which when someone dies, how their next of kin get their superannuation.
I want to reassure the committee that we remain focused on our members and their best financial interests. And like many institutions experiencing rapid growth, it has taken time for Cbus to mature.
So Cbus has self-reported this amount as about $20 million. But this is back of the envelope maths, just note. But if you look at how many claims it failed to process, which is about 10,000 over 6,500 members, and then you look at what it says is its average payout for these claims, that figure could actually tip over $1 billion.
That's a lot of money.
Yeah, it is. And a lot of people are sort of validly asking, where does this sort of shortfall come from and where does any penalty that ASIC gets come from? These are not-for-profit funds. How do they finance these issues? So that's a pretty shocking failing. It's left people without money at their most vulnerable time. Cbus has said a lot of it comes down to its third-party administrator not really doing its job, a company called Link, except ASIC has said, no, sorry, you can sort of contract out your services to who you want, but at the end of the day, it's up to you to make sure it's done properly.
Consumer advocates say the case has finally made people pay attention to a problem that has been around for years, and that is the poor claims handling across the sector. How big a problem is it?
It's massive. So for a start, this issue with a third-party administrator even if funds ultimately need to be accountable for that, most funds that don't do it themselves use Link. And while more funds are starting to do it themselves, that process to bring it in-house takes a long time. So they may be starting now, but it won't happen for a while. All you need to do is look at the Facebook pages of some of these super funds to see that the issues spread way beyond Cbus.
All these people are going through grief and trauma and stress, and they're playing with people's lives.
The emotional toll of losing your partner is unbelievable. And this is just extra stress and burden at a time that you really don't need it. And I really didn't think it would be this hard.
Every fund's page is littered with complaints about it taking years to get a payment, or, someone whose brother had died, making the note that they had made her sister-in-law wait 10 months for a death benefit payment that they really needed. You had the same issues coming up at Australian Super. There was at Australian Retirement Trust, there were people encouraging each other to file complaints about customer service, just trying to get enough of a critical mass that they were heard. The government's warned funds about this, that they need to lift their customer service, and fund CEOs have conceded themselves that they've been way too focused on the idea of accumulating wealth and sort of building up members' savings and not enough on actually servicing them. So it's sort of the next big issue for them to look at. ASIC has been looking really closely at this death benefits issue. They've done a surveillance of 10 funds. They've warned that there's more cases to come in the new year. They've also said that what's happening with death benefits is just a microcosm of broader customer service issues, so to expect more in that space.
James, the claims handling and administration is one area of scrutiny, but there's also attention being paid to the governance of these industry funds. In the case of Cbus, it's not just ASIC having a look. The prudential regulator, APRA, has also been looking at the makeup of the Cbus board, which includes 3 directors linked to the CFMEU. Can you explain how industry funds select their directors, and why did APRA raise concerns about the Cbus board?
The industry funds have always used a model called equal representation to put directors on their boards. So Cbus is a good example. In their case, the CFMEU can nominate 3 directors, other unions are allowed to nominate 3 more directors, and then the employer group at the heart of Cbus, the Master Builders Association, they can nominate 6 directors. Now, that's all worked pretty well for a long time, but the question is whether they're getting directors with the right experience. And as the super system changes from this period of building up assets, accumulation, to this retirement phase, deaccumulation, will the super fund boards need to bring in people with different experiences, maybe people who are experts in retirement or people from different geographies now these funds are going global? But the equal representation model doesn't really allow them to do that. They have to pick these people from these relatively shallow pools of unions and employer groups. The board of Cbus has just been repopulated with 3 more CFMEU directors. But instead of going to get, say, people with experience in retirement solutions or administration or some of these issues that they're facing, what we've ended up with is 3 long-term union officials. There's one guy, Paddy Crumlin.
They seek to take away our right to work in the docks. They're taking it away because it's a form of union busting.
He previously ran a super fund which was actually dubbed by regulators as the worst super fund in Australia. Another CFMEU director, Jason Mara.
And it's only us to stand together, stand up, fight back, change the rules, make sure that we get our share, that the working men and women of Australia get the piece of the pie they deserve.
He's a former union official and is now the general manager of operations at the union's Canberra Tradesmen's Club. And the third CFMEU appointee, Lucy Webber, is a union lawyer. Now, we don't really know all that much about their experience, but what we do know is that they're on there because of their CFMEU ties. And as we know, the CFMEU is in such strife at the moment, it's been placed in the hands of external administrators. So there's a question over whether these guys are properly qualified to be on the board at the moment. Cbus chairman Wayne Swan, he defended the appointments last Friday at a Senate inquiry.
Are you saying now that the 3 new people, including Mr Crumlin and Mr Mara, have been signed off as fit and proper?
Yes, I am, absolutely.
He said all the directors, including Paddy Crumlin, had extensive experience.
It's quite an impressive list.
As you said, in August, the Australian Prudential Regulation Authority made an unprecedented intervention into Cbus after the scandal broke about criminal activity inside the CFMEU and ordered Cbus to do a review of its board. Are the directors, not just the CFMEU appointed directors, but are all the directors fit and proper people to be on that board? How did governance work? How is the board constituted? The results of that review came out this week, and surprise, surprise, all of the directors were found to be fit and proper people. But the review has raised some questions about how governance processes work on the Cbus board, and they say they're going to make some improvements over time.
Mm-hmm.
Proponents of the equal representation model, like Swan, point to the unquestionably strong returns that the industry fund sector has produced for decades as proof that the model does work. But I reckon the question is not whether the model has worked in the past, but whether it needs to be tweaked or improved just a bit for the future.
You mentioned Wayne Swan there, James. There's been a lot of focus on him through this story. He's a Labor power broker, a former treasurer, and to some, he's emblematic of a concern that industry super is too close to Labor. How would you rate his response to the ASIC case? And do you think he's the right person to chair Cbus?
Swan's very defensive of the industry super sector. I interviewed him at the Australian Financial Review Super and Wealth Summit in October.
So to paint the discussion about what's going on in the CFMEU as being totally about the Cbus board is completely inaccurate and hysterical, not justified.
And he said basically that industry funds are under attack from critics who are jealous of these funds' success.
We're about to join the $100 billion club. And how can it be, with the sort of world-beating returns that we've had over 40 years, that the union representation on our board has been a drag?
He accused those questioning Cbus of quote-unquote raw politics.
We don't have anything to hide. Some of the commentary around is designed to do deliberate damage to our fund.
Which is fair enough, I guess, and the numbers do back him up. The returns have undoubtedly been impressive from the industry funds, but he is actually meant to be an independent director and not sort of a flag bearer for the union movement or the labour movement or industry funds in general. I think this is the question, that in getting so defensive about the industry fund model, he sort of fails to recognise that there might be ways to tweak or improve it.
So there's an example that critics tend to focus on when they're looking at whether Wayne Swan's too connected to the Labor Party and if he can be truly independent. And that's this HAF, which is the House in Australia Future Fund Jim Chalmers set up last year. That's an investment vehicle that's designed to fund more affordable housing. It will be about $10 billion. Cbus has committed $500 million over 5 years. Chalmers tried to get a lot of super funds to pour money in. The only one that said yes was Cbus. That's only a theoretical commitment, but people who are a bit critical of these connections tend to point at it as an example of sort of saying the ties to Labor are so strong. Where's the line drawn in terms of whether these people can be independent?
The problem is that Wayne Swan is out there saying, we don't need to change, it's all good, we're fine, look how strong this industry is. But what he's not saying is, let's look at ways to improve. Let's look at the equal representation model, for example, and see if it still works or could we do better. I think that's because he sees the industry fund sector as a movement. It's not a business. It's got a whole pro-working class underpinning. But of course, behind every movement there are zealots and they're often not open to change. And the risk is that Wayne Swan and other industry fund leaders come across in this way. But if the industry fund sector can't look at itself and try and improve, then it could face a reckoning.
Hannah, we're talking about Australia's $4 trillion superannuation sector and the customer service and governance scandals engulfing one of the biggest industry funds, Cbus. The banks and wealth managers went through a reckoning with the Banking Royal Commission. As James has suggested, is it Big Super's turn?
Yeah, well, it's really looking that way. The super sector managed to avoid the full force of the Hayne Commission's scrutiny, and APRA, by its own concession, says it's been focused more on its banking and insurance arms than super until now. Super's also enjoyed a largely disengaged customer base. It's got guaranteed payments coming in from members, which are going up every single year. That will soon stop. There's also been a slew of reforms that are in consumer interests, such as stapling them to individual funds, but at the same time has made harder for them to shift funds and disincentivised what could be higher engagement. But the litany of complaints on social media show that there's now human faces attached to these problems. People are starting to talk about it more. That's what happened in the Hayne Royal Commission, was as soon as these sort of more technical issues around trailing commissions and the like had a human face put to it, suddenly there was a lot more public scrutiny, many more demands for change. It was tough on the banks, but they're better for it now. We're not sure yet whether industry super uses this chance to do the same. As James has said, a lot of it comes down to sort of how willing you are to look at issues and how willing you are to change yourself. But the recent regulatory activity from both ASIC and APRA suggests that it may not actually get a chance. The change may be forced on it. Those regulators aren't just looking at the administration and claims handling of funds or their board governance. They're looking at how these super funds spend money. You know, when you see Host Plus sponsoring the Richmond Tigers, now APRA is saying, is that actually in members' best financial interest that you use money there? They're looking at returns. So a big issue has been unlisted asset valuations, in particular property, because commercial real estate's plummeted so much recently. So now the regulators are looking at those assets, saying, how are they valued? Are these the best investments? Then there's a whole nother element where the Reserve Bank has started to say, you guys are getting pretty big. You're very invested in our banks. You're sort of entering the economy in different ways through private lending and the like. Could there be sort of a systemic risk to the broader financial system here? And how do you manage that?
Yeah, I think the thing about the Royal Commission is a lot of the stuff that was revealed in those public hearings was actually pretty well known. I mean, we all knew that there were trailing commissions being paid to advisors. We all knew that there were fees for service that were charged on an annual basis. But what the Commission was able to do was go in and sort of expose these as the misconduct that they were, the sort of nasty little things lurking in the shadows that everybody had ignored for too long but really shouldn't have ignored. And all of a sudden, all this boring stuff that nobody paid attention to became a lightning rod for change in the sector. And I think that's the issue here. Super is pretty boring for many people. And the administration of super, well, that is the most boring part of the most boring sector in the world. But there's a really important job being done here. Super's not just about the cool building up the assets part, flying around the world, doing deals, investing in private equity or buildings or infrastructure or roads. The important part's actually when you give the people, your members, you give them back their own money. And I think this is where the problem lies for super. If their administration is shown to be lacking, if they can't pay insurance claims and death claims when they should, then what they're doing is failing to do the main job that they've been appointed to, help people manage and enjoy a prosperous retirement. So I think that's where you start to get the risk of confidence in the sector starting to crack. That's what we saw with the wealth managers. You know, AMP went from being this 175-year-old institution to within sort of 5 years being a bit of the forgotten company inside the wealth sector because confidence in the business cracked. And that is what the super sector has to avoid. I'm not sure we're there yet. I mean, the flow of government mandated money into the sector certainly means that the industry's not going anywhere. But the super funds cannot afford to see confidence in their business crack in the same way that the Royal Commission cracked confidence in banking and wealth for a little while.
You mean people starting to question the very idea of super and mandated super?
Yeah, we're forced into this sector, right? We don't have a choice. So if you got examples of the money being poorly managed or poorly administered, then people might say, hang on, why am I forced to give 12.5% of my savings into this vehicle? Is that the right thing? It's not really doing its job. Do I really want to be in this? And that will open the super sector to exactly what Wayne Swan and the industry fund movement doesn't want to see, and that's questioning of super's role in Australia. I think that would be a bad outcome. Super is playing a really important role in Australia. It is underpinning a world-class retirement system, but you've got to keep improving it and making sure it gets better.
So what do the Cbus troubles mean for the super wars? Do they give ammunition to those arguing for changes to the superannuation system?
Absolutely. I thought the super wars were over, and I think at our Super and Wealth Summit earlier this year, our Editor-in-Chief, James Churchill, actually declared the super wars are done, this is all in the past. But what we've seen with this Cbus thing is it's come straight back. You've got the same sort of old battle lines drawn, the Liberals whacking the sort of idea of super and its connection to the union, and then on the other side, Labor sort of saying, no, this is a really important thing for workers. This is a movement that we believe in. So the mindless sort of super wars are back, but what we're not getting is anyone focused on trying to find solutions. How do we improve the sector? It's good now. How do we make it even better in the future?
Yeah, look, as inevitable as it may seem that we're back at the super wars, I think everyone would benefit from us not returning to that as kind of the language of the fight. Whether you're with a retail or industry super fund, you still need to get money in your retirement. You still need good customer service. These funds are at the coalface of an absolute tsunami of baby boomers that are heading for retirement. In the next 10 years, there's going to be 3 million more members eligible to draw down their funds than there currently are. And funds really need the customer service, the financial advice, the liquidity to do that. If we get caught up in this sort of technical fight over whether it's an industry or a retail fund, which the funds themselves sort of feed by really fiercely identifying themselves as either of those, then where does the conversation about what's best for the entire sector go? It sort of gives people an excuse of something to focus on instead of the broader picture.
So if we forget the politics, forget the super wars and focus on how to improve the sector, James, Hannah, what do you think should happen from here for both Cbus and across all industry funds?
There's two issues going on here. One is the sort of crisis that's built up around fixing this administration problem. That's got to be the first order of business. But then I think super funds need to step back and sort of see this as a hinge moment. We've had a great 32 years of building this sector up. It's gone very, very well for Australia's retirement system and Australia's retirement savings. But what does the next 30 years look like? That's when we're going to see Australia's ageing population move into the retirement phase. And the super funds need to ask themselves, are they ready for that? At the moment, based on what we're seeing with these administration problems, you'd have to say they're not ready for it. And remember, we're only at the very start of that wave of retirees. It's only going to get bigger, and these problems are only going to get more complex to solve. So the sector needs to step back and say, we've done well so far, but what are the things that improve the sector for the next 3, 4, 5 decades? Do we need different experience on our boards? Do we need different ways of handling our administration as our funds get bigger? What's the right mix of skills in our management ranks and on the boards? How are we going to handle being increasingly global? Because Australian super funds have really invested just about as much as they can invest in Australia, and more money will be invested offshore. So this is an inflection point. And the super fund industry can get this right, but they've got to get out of this mode of being very defensive and start thinking about how do we improve.
Yeah, I think for the funds, a lot of it's about thinking, how do they want to be seen in the future? A lot of that comes from asking yourself, what do we want to be giving to members? Is it just about growing their balance, or is it about giving them the best customer service, the best experience when they have a disability claim, when someone dies, the best returns for their retirement, and the most knowledge around that with financial advice going forward? There's also this really great opportunity for them here to sort of position themselves as a leader. This is it's a novel issue for the world. There hasn't been a retirement income system set up like this anywhere. And it's a really great one. Full credit to those who did it. So if you're among the funds and you lead the industry in where you go next. That really gives you a lot of power in terms of, as an investor and as kind of a model for what a good system can look like for other countries that are trying to set this up themselves.
Thanks, Hannah. Thanks, James.
Thanks for having us, Lisa.
Thanks, Lisa.
Thank you for listening to The Fin. I'm Lisa Murray, with James Thompson and Hannah Wooten reporting today. The Fin is produced by Alex Gow and Lapfan. Fiona Buffini is the executive producer. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us, as it helps others find us. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. See you next week.
The Australian Financial Review.